Since I still appreciate you, let's find love while we may. Because I know I'll hate you when you are old and gray. So say you love me here and now, I'll make the most of that. Say you love and trust me, for I know you'll disgust me when you're old and getting fat.
And on that note, welcome to Divorcing Your Mortgage. I'm your host, Mark Gertz. Many of you may have thought that you were tuning in to Jay Kaplan today, but unfortunately, if you haven't heard, Jay passed away last month, um, and um, and we have taken over his spots. We are going to continue some of his conversations about reverse mortgages, which were the passion in his later life. But we're going to expand the conversation as well. This program, Divorcing Your Mortgage, is not just about divorce and mortgages, it is about divorce in general. Um, as I mentioned before, my name is Mark Gertz. I am a certified divorce lending professional and a mortgage broker. Um, but we are going to take the conversation into all aspects of mortgages in America today. And why are we going to do that? Well, that's because 1 out of 2 of you are either getting divorced or are divorced or have been divorced. And it's a topic that is rife with emotion. And there's a great deal of misinformation out there about what you can do and what you can't do, especially in the great state of California where the show originates. So we're going to cover all aspects of that. And each week we're going to have on a guest, sometimes maybe two, to talk about different aspects of divorce and to look at different ways that you can basically protect yourself so that if you're going through a divorce, you kind of can figure out what you're doing instead of um, figuring it out after it's too late. All right. So, on that note, I want to talk to you about one simple opening topic, which is sort of an homage to Jay. What happens to a reverse mortgage after a divorce? Does anybody out there know? Well, let's find out. Couples can divorce later in life for the same reasons that younger couples split up. But, when you're over 50, these reasons are framed by aging and the realization that you've got more years behind you than ahead of you. While there may be differences in the emotional impact of divorce for couples who end their marriages later in life, the biggest difference is that there's less time to recover financially. Divorce rate for those over the age of 50 has doubled since the 1990s. People 65 and older, the divorce rate has tripled from 1990 to 2015. Why? I don't know. We're going to discuss some of those things today. A reverse mortgage is a type of loan that allows eligible homeowners, those at least age 55 and up, to withdraw equity from their homes without having to make payments in their lifetimes. They must own the home outright or have paid down most of the mortgage balance. The borrowers must occupy the property as their primary residence at all times. Unfortunately, there aren't very many programs out there that allow you to use property that you're not living in. The mortgage only becomes due and payable when the home is no longer the borrower's primary residence, or you pass away. And this can happen when they move into a retirement or assisted living home or upon death, or also if they sell the property. When a reverse mortgage is obtained, the initial loan proceeds will be used to pay off any mandatory obligations, such as an existing mortgage or tax liens or even those solar panel loans that many of you have. During recent years, the payout of the remaining proceeds from a reverse mortgage is limited to about 60% of the principal limit. Now, many of you may have heard that term before, principal limit. That's a fancy term, and all it means is the maximum loan amount that you can borrow. So if a reverse mortgage is going to be used to pay the other spouse their equity share incident to divorce, you need to make sure the equity buyout is a requirement of the divorce settlement. Let me repeat that. You need to make sure that the equity buyout is a requirement in your divorce settlement if a reverse mortgage is going to be used to pay the other spouse their equity share incident to divorce. So it becomes a mandatory obligation, and it may be paid immediately through the reverse mortgage. This is what you want to accomplish if you're going to use this type of a loan to solve a divorce situation. Now, what happens when a couple divorces and there's already an existing reverse mortgage on the home? If both spouses are mortgagees on the current reverse mortgage, one spouse may still elect to stay in the marital home with no acceleration of the mortgage note. Now, let me say that to you in different terms. If the two of you are living in the house, if you're a married couple, and both names are on the title and both names are on the mortgage, and you get divorced, and one of you wants to stay in the house, guess what? You don't need to refi, because under the reverse mortgage terms, one of you has to occupy the property. If the other one left due to disability or death or even divorce, it doesn't make the loan come due. You can stay there and nothing has to change. The spouse may elect to submit the final settlement agreement to the mortgage servicer, and the vacating spouse may be removed from title to the home as well as the existing mortgage. So if you're in a situation with your husband or your wife, and they're saying to you that they can't be taken off title, well, guess what? That's not true. You can take them off title in your divorce settlement and still keep the reverse mortgage on the property. But the spouse that left, what we call the vacating spouse, may then elect to use a new reverse mortgage to purchase a new home. Okay, what does that really mean? Well, that's a pretty darn good thing. What that says is that if the two of you have a reverse mortgage now and you get divorced and one of you wants to stay in the home, the other spouse, the one that has left the family home, can now go buy their own property and get their own reverse mortgage. That's right. So that you can each have a reverse mortgage at the settlement of the divorce. But what happens if the spouse who wants to retain the marital home is not on the existing reverse mortgage? Now, there aren't that many of you out there, but there are some situations where one spouse is on the reverse mortgage and on the title, and the other spouse isn't. Well, just to make it more complicated, there's two classes of non-borrowing spouses. One is an eligible non-borrowing spouse, and one is an ineligible non-borrowing spouse. What those two terms mean is that at the time that the loan was taken out, if you were eligible, it meant that you could be on the loan, but you chose not to be. If you were ineligible, you couldn't be on the loan, even if you wanted to be. How a spouse is listed on a reverse mortgage can affect their ability to stay in the home if the other spouse moves out or passes away. If the non-borrowing spouse was ineligible, couldn't be on it even if they wanted to, at the time that the present reverse mortgage was taken out, if they are now eligible, perhaps the easiest remedy is to obtain a new reverse mortgage in their name to pay off the existing reverse mortgage. In that situation, there'd also have to be enough equity to do a refi like that. Otherwise, the existing reverse mortgage may need to be refinanced or paid in full in order for the ineligible non-borrowing spouse to remain in the home. Now, whether it's because divorce is more acceptable now than it was in the past, or because more elderly couples are running into unsolvable issues during retirement, Many factors contribute to the high divorce rate among seniors. While divorce is never easy, it can be uniquely challenging for seniors. Regardless of the why, serious financial conditions for divorcing seniors may impact housing and real property concerns. You know, a long-term marriage in the state of California is defined as anything more than 10 years. How many of you know relatives or people that have been married 30, 40 years? Okay, well, at the time that people in their 80s or 90s today got married, life expectancy wasn't much above 60, 65, 70. In many ways, you could say that nowadays we live three lives. The first one ends at 30, and the second one at 60, and the third one at 90. Anything after 90 is a bonus. But many people didn't expect to live. Many people in the 20th century didn't expect to live beyond 60 or 70 years. That's kind of what you expected, maybe 75. But today, 90s, 100, becoming more and more commonplace. My own father is 97. God bless him. So in many cases, after being married that long, it takes its toll on a relationship and a couple. And I think that's one of the reasons why in many cases we have a substantial increase in what's known as gray divorce. And one of the big things about divorce is that when you do it, all of a sudden you have two households to handle. And housing is a primary necessity, irrespective of age. So these are things that we really need to take into consideration if you're really going to put yourself in that situation to get divorced. You know, there's for those of you that don't know, there's something called collaborative divorce, or a lot of times it's known as mediation. And in many cases, it can be a lot less emotionally charged and a lot less expensive than a more traditional divorce. One of the problems with agreeing to mediation or a collaborative divorce is not intelligent thinking, but emotions. Emotions. Many times, we find ourselves in situations where we want to get back at the other person, either for something real or something imagined. Well, it's bad enough to do that in your 20s and 30s and 40s. But guess what, folks? In your 60s and 70s and 80s, it's even worse because there's less time to recover financially. There are additional problems, especially with regard to health and cognition, your ability to understand stuff. And basically, if you're going to get divorced, you want to try to do it as amicably as possible. Right? Okay. So we have a great guest coming on the show. I hope you'll stay with us. We're going to break for a commercial, and then we'll be back with Divorcing Your Mortgage with me, Mark Gertz. And we're back on Divorcing Your Mortgage. I'm your host, Mark Gertz. Irrespective of the title of the show, we are going to cover all aspects of divorce in America. And to that end, my guest this week is Sathya Che Pedersen. Sathya is a managing partner at Arise Private Wealth, an independent wealth management firm that consistently guides clients to pursue an elevated perspective. Sathya has been a consistent pillar of sound judgment and an advocate for her clients' success. Her guiding principle in life and as a wealth management advisor is to imbue her love for life and all of its plentiful opportunities that are attainable and within reach when you not only have a plan, but take concerted action to make it one's reality. She is more than a wealth advisor. She is her client's financial beacon, consistently offering an informed perspective so they can craft and implement an effective investment strategy that's suited to their specific needs and desires. She understands that many complex financial decisions her clients may face, as well as the intricacies of their portfolios and investment markets, and ensures her clients are cared for today and in the future. And I also want to mention that she is a certified divorce financial analyst, and we're going to talk a lot about that aspect of her career. Hello, Sathya.
Hi, thank you for having me.
It's our pleasure. It's our pleasure. So maybe on that note, you could explain to us for a minute or two why it was that with all of the things that you do with regard to wealth and wealth management for clients, that you chose to pursue getting a certified divorce financial analyst designation, and actually what that means.
Yeah, so you mentioned in my bio how I mentioned that I act as my client's financial beacon, and I think a part of that is always becoming well versed and understanding all the situations my clients might find themselves in, which unfortunately in some situations is a divorce. And with an already emotional uh, issue in their lives, just along with investing and many other financial decisions, I help to remove the emotion from that and help them make the best financial decision they can. And so, pursuing my certified divorce financial analyst gave me a better understanding of the financial impacts of divorce on a person.
Hmm.
Um, and
Okay.
so, yeah.
What does a CDFA do?
So a CDFA can act in multiple ways for a client. In the way that I utilize the designation is I utilize the education I got from receiving the designation and understanding more in depth the divorce process and again how it impacts clients financially. But CDFA could work with your arbitrator or your mediator to help gather all the financial documents, analyze and propose and present different ways that you could be splitting the marital assets or alimony, et cetera, to a way that's financially equitable for both parties. In a collaborative divorce, a CDFA um, works with the team, the collaborative divorce team, to also make sure that both needs are being met. They could be asked to be the financial expert in a divorce in court as well. Um, so, with most people, especially attorneys, even though they're really good at their family law, they may
Hmm.
not be good at communicating or projecting the financial impacts of different solutions they offer you because splitting everything in half may not be the best decision.
Yeah, but isn't splitting everything in half the law in California, for example?
Yes, but there could be assets that maybe a couple's retirement plan or a person's retirement plan or their primary residence is usually their largest asset, right? So
Hmm.
the best thing might not be to sell the house and split the proceeds, right? You need to look at what is the mortgage, what is the income of each spouse.
Hmm.
Are there minor children involved? Do the children are better off staying in the home with the parent that's going to be taking care of them most? So there's a lot of other reasons besides just cutting everything in half um, that should be
Okay.
considered.
What can you explain just for 1 second? But what does a financial analyst do in a divorce situation? I mean, are you analyzing the psychology of the clients? Are you analyzing the assets, the income docs, disclosure? Where do you get
Yeah,
involved?
so you're gathering well, it depends on the type of divorce that you're brought in the situation you're brought into, but you're gathering all the statements for both spouses. You're looking at their W-2s or their tax returns. You're fully understanding the financial picture that they have as a couple.
Hmm.
Then you are taking into some um, more non-quantitative factors, right? Like has the one spouse been the stay-at-home spouse most of their relationship? Okay, so how is this person going to, um, you know, stay in the home, pay the mortgage if they wanted to be the one to stay in the home. So once I gather all those financial documents and then speak to each spouse or the one spouse I may be working with that,
Mhm.
um, what their goals are, or, what they need to feel financially secure, then we work with the attorneys, et cetera, to propose a solution that would work best for them.
Okay. So, but there are different types of divorce, right?
Right.
Okay.
Hmm.
Um, is um, is what you do better suited for one than the other, or not
Yeah, I
necessarily?
mean, I think there's CDFAs that work in all types of divorce. Um, some like to work in collaborative divorces only. Like you'll find a lot of attorneys, some only do mediation and collaborative divorces, right?
Hmm.
In litigation, they're just burned out, a lot of fighting. So I find that most CDFAs want to work in that collaborative divorce arena where everyone's working as a team, and it just you feel like your work in analyzing and seeing the best solution for the couple
Uh-huh.
is most likely um, that advice is taken, that recommendation is taken, versus if a CDFA is hired in a litigated divorce, most of the time, one spouse is not going to be happy with the outcome and they're going to argue with you why it's not the best solution.
I see. Okay. What is the difference between a collaborative divorce and mediation?
So with mediation, you typically have, and you should definitely, speak with someone considering divorce should definitely speak with an attorney to see which
Hmm.
type of divorce is best for their situation.
Hmm.
But with mediation, you have a mediator that comes in and helps you decide, um, helps, is that third party unbiased person who hears both of you out and helps you come to an agreement.
Hmm.
Whereas in a collaborative divorce, you both have attorneys, you have maybe child marriage and family therapists involved, you have a CDFA involved, you have a whole team. Everyone always meets together. It's very transparent. So there's just unlike a mediation where it's just a mediator and the couple,
Uh,
this involves so many more people. Both have attorneys. There's a CDFA or a financial expert involved. There's usually a therapist involved
oh,
um, to make sure that everyone maintains, you know, their maintains peace within it all,
I see. Okay.
and conflicts are avoided.
Stays collaborative.
Exactly. There you go.
Okay. All right. So maybe you could take a moment and just explain to us what your journey is. How did you, where did you start out? Where did you grow up? How was it that you got into finance and this type of thing?
Yeah, yeah. Well, I hope you have an hour. But
Reader's Digest. Reader's Digest.
yeah, Reader's Digest. So I have 15 years of experience in wealth management. This is my first big career. I'm not a big career changer, although I've been working since I was 9 years old. Um, my family all survived the Cambodian genocide that occurred in the late 70s. I was born in a refugee camp in Thailand.
Oh,
So we came to this country very poor, and I mean poor on food stamps, eating food out of the trash cans outside of grocery stores, um, really just pulled ourselves up by the bootstraps to eventually become business owners. The last business that my family owned was a used car dealership where I did the financing there.
aha.
And then as soon as I completed my degree at Cal State Fullerton in finance, I immediately jumped into the corporate world or working for someone else at a wealth management firm 15 years ago.
Hmm.
And so through hard work, I knew that I chose my career because I knew I wanted to make money and I knew I wanted to help people. So why not make money helping people make money?
Gotcha.
I saw firsthand what the lack of money does. You don't have the time to enjoy with your family. You don't have the time to pursue your passion. And being that I came from a background where I feel so lucky to be alive, to be in this country, I just thought it was such a shame that there's so many people in this world that are, head down, trying to work hard and make money, and they never really find the peace to get to a point where they can have the freedom to do what they want when they want, which is
Mhm.
really what we want, in
Mhm.
life.
Mhm.
And yeah, so I spent 15 years and I just started my own firm, Arise Private Wealth, in June of 2021 during the pandemic.
Mhm.
But I just felt like working, I was previously at Wells Fargo Advisors, being affiliated with a big bank and was just not giving me the freedom to do for my clients what I want.
I see. Okay. Well, that's quite a story. That's quite a
Yeah.
story. Um, what would you say? What would you say is the biggest? Just digressing for a second. What would you say
hmm
the biggest obstacle to people developing wealth is?
Um, I would say the biggest obstacle is discipline. Discipline to save,
Mhm.
discipline to live within their means, discipline to stay invested when markets are volatile.
Mhm.
Um, those three things are really what prevents someone from accumulating and keeping their wealth. People are, there's some people out there that are always chasing the next hot thing that's going to give them a 300% return and
Mhm.
turn the little that they've chosen to save into four times what it was.
Right.
Where, as I always tell people, Warren Buffett has been investing since he was 10 years old. He made
Mhm.
97% of his wealth after the age of 65,
Mhm.
and he's not the best money manager out there. There are people with better returns than what he has over his lifetime, but he has consistency and he has time. And I think people just lack the discipline to really just make wise financial decisions.
I
And it's
see.
way more simple than we all think it is.
Just compound interest, right?
Exactly.
Just compound
Exactly.
interest. Um, what would you say, segueing from that, what would you say are some of the major financial considerations in divorce?
Um, Really, I think, there's financial, so many emotional, financial decisions, um, really stepping back and understanding that, your life you know, obviously your life is going to be different from you know, who you're around and being able to lean on that person or not lean on that person. But your lifestyle may change. And I think being not being so beholden to um, or resistant to that change,
Mm-hmm.
I think starts a better dialogue that helps people get to a point of agreement sooner. Um, so I think people need to think about cash flow. I think people need to think about long term, because some people may be so focused on splitting, all the investment accounts and everything, the investment accounts and the house in half. And what about
Mm-hmm.
the equity in the home? Well, what about pension plans that could give you a lifetime income, that would give you that peace of mind?
Mm-hmm.
What about the capital gains that you would incur by selling the investment portfolio when the market's down?
Mm-hmm.
So there's so many tax considerations, lifetime of income, cash flow that you really need to just make sure you take a step back and
Mm-hmm.
talk with a professional about how all these little decisions could impact you over the long term.
Mm-hmm. Um, you've been involved, I would imagine, in many divorce situations with your clients over the years, right?
Mhm.
Considering the fact that, one out of two people in the United States has been divorced. Um, were there any situations that you were in where in your heart of hearts you knew that these people could not afford financially to get divorced?
Yes. And I had one couple that chose to do a legal separation instead, where they remained legally married, and but the the husband in this case paid the ex-wife alimony, took care of her expenses. But
Hmm.
there's certain situations where they didn't need to be legally married if they weren't planning to remarry or whatnot, but staying on the ex-spouse's health insurance and
Right.
unwinding the primary house or all of their real estate was just too cumbersome, and they were
Hmm.
at a point where they were like, "Look, we just don't like each other and we don't want to live together, but you've always taken care of me." And there's many couples that just say that, like, "I don't want to be around you, but I love you and we've been together, so of course I will always take care of you. So let's cut out the legal mess and just keep things how it is on paper, but we'll work out a
Well, let's
separation
let's
agreement."
let's talk more about that when we get back. You're listening to Mark Gertz and Sathya Che on Divorcing Your Mortgage. The call-in number is 951-922-3532. We'll see you when we get back from our commercial. It's good to talk to you, Sathya. Thank you. Welcome back to Divorcing Your Mortgage with Mark Gertz. Our call-in number is 951-922-3532. We are talking today to certified divorce financial analyst Sathya Che. Sathya, separating property versus separate property versus marital property. How do you keep these assets separate? And can you maybe give us an example of a client where that was a big deal?
Well, I think first and foremost, well, the rules vary state by state in
Hmm.
terms of marital or separate property. So I don't know where all your listeners are from, but so you want to make sure you're aware of what those rules are in your state. But typically, assets that how the manner in which they are held, right? If
Hmm.
they're jointly held or individually held, if they were acquired before you were married. So, for example, if you inherited a rental home, from your parents, that was your home growing up, and then you kept that title of that home in your separate property,
Hmm.
um, would be considered separate property. So, um, definitely title, the source of the asset,
Hmm.
where it came from, and the time in which you acquired it. In many states, even if you acquired it separately or before the marriage, they assume that the appreciation of the asset during the time of the marriage would be considered community property. So that's why I always encourage people to get a prenuptial agreement or a
Hmm.
postnuptial agreement if you didn't get to tackle that before you got legally married, because a lot of this could be clarified in those agreements. It's funny, but a prenup or a postnup is essentially going through a divorce while you're married. Um,
Yeah, since you bring that up, I'm sure a lot of our listeners would be interested in going down that road for a moment. Um, there's how would I put this? A lot of people feel that prenups and postnups are um, how would I put it? Indicates that you don't care about the person enough, because you don't love them enough just to get married. You want to deal with the money. You want to deal with the things, the assets. Um, what are your thoughts on that?
Being that I just got married last year and
Congratulations.
we thank you, and we went through the process of putting together our prenuptial agreement before, and we literally signed it 3 weeks before we were legally married. So that made it a little bit, because there were negotiations and there were tense conversations leading up to
Uh-huh.
too close to the wedding. Um, I think you can't help but feel that way. Hopefully, my husband and I, we talked about it and said, look, you work hard, I work hard. Um, let's just respect each other enough to have this conversation before, while we love each other and while we want to do the best for each other, and it
Hmm.
really avoids conflict later. So that's how we posed it to each other, is like, we love each other the most we will now. So why don't we talk about this ugly thing, that if it were to ever happen, we at least are doing so in the most loving time, where we're being the most fair to each other.
And even doing it in that environment, you found it stressful.
Yeah, yeah, because there's just some things that are uncovered where you think you see eye to eye, and then when you introduce legal jargon, or attorneys are always looking at prior court cases that have been argued, and what was challenged, right? Because the attorneys are wanting to write the prenuptial agreement
Mhm.
in a way that it cannot be challenged, right? And so once you kind of put in all those little tweaks,
Yeah,
we were starting to feel like this wasn't what we thought. But I guess it needed to say it legally the way um,
I
it needed to
gotcha.
be held up in court.
I gotcha. Um, how exactly? So taking that into consideration, and taking into consideration a couple that's not looking to necessarily get divorced, but all of a sudden they decide they want to put together a post-nuptial agreement. Can you talk for a moment? Have you been involved in those?
I've not been involved in a post-nuptial agreement, but I assume it works the same as a prenuptial agreement. For it to be effective, each party needs to have an attorney,
Uh-huh.
and usually one attorney drafts the baseline document.
Right.
Um, and hopefully you and your spouse came together to kind of say those baseline things that you agree upon, so
Mm-hmm.
that then when it's sent to the other spouse's attorney, there
Yeah.
isn't much more revisions. Which, if the attorney's doing their job, there's going to be a lot of revisions, because they're going to want to make sure that they're charging the hours to make their time worth it. But also make sure you're protected, because one attorney is always going to be protecting one spouse more than the other. But that's why, to make it legally binding in court, both
Mm-hmm.
spouses should have attorney representing them to make sure that on both parties it's fair. Um, and
Okay.
so, yeah.
Okay. Um, can you have you been involved in divorces where there were life insurance policies?
Um, yes, yeah. Hmm.
Okay. As a CDFA, how do you get involved in sort of dividing those? How does that work?
Well, it usually, obviously the the life that the insurance of the spouse that it's on usually protects the other spouse, right? So
Mm.
what I've seen happen is, um, usually it's the spouse that is receiving the alimony or is more financially dependent.
Mm-hmm.
Part of the separation agreement requires the higher earning spouse to continue paying the premiums.
Mm-hmm.
So if that spouse were to die early, and of course the alimony goes away, there
Right.
would be a way that that surviving spouse would continue to get some level of income
Gotcha.
or benefit.
Okay. Well, thank you. Um,
Mhm.
we've been talking to Sathya Che Pedersen. Amongst her other initials, she is a CDFA, a certified financial analyst, divorce financial analyst, and she's been enlightening us on many different aspects of divorce, as we are going to do for the rest of the year on divorcing your mortgage. Sathya, if anybody wants to get a hold of you to talk to you about your services, where's the best place for them to reach you?
They can go to my website, Arise, ARISE, privatewealth.com, and click on the Contact Us button. Our email is ready2@arisepw.com if they have any questions.
Thank you so much.
Thank you.
And we're back, and my name is Mark Gertz, and this is Divorcing Your Mortgage, where we discuss everything having to do with mortgages in the United States. We just finished with our guest, Sathya Che, who was a certified divorce financial analyst and enlightened us on many, many aspects of what she does when it comes to collaborative divorce. There are a few things that I want to cover with you before we go off today. And I would imagine that many of you listening out there are in your cars and in traffic now, it being almost 5 o'clock on a Friday. We do hope that you tune in every Friday from 4 to 5 to learn what you need to know about what you don't know when it comes to divorce. You know, the 70s are the new 50s now. Gray divorce differs from typical divorce in many ways. And there are a few reasons that researchers have found explaining the data of the increase in gray divorce. The first being that couples who are typically married more than 20 years have simply grown apart. And the stigma of divorce no longer exists as it did for our own parents. Gray divorce is not the same as a typical divorce. Most older divorce clients are retired, near retirement, or have reasons why they aren't yet retired. Most gray divorce clients have grown children and even grandchildren. And most gray divorces will have a complicated division of assets due to the length of the marriage, as well as the stereotypical generational roles of the husband as provider and the wife as homemaker. I personally have been involved in many situations where couples were dividing, and there was a very stereotypical, I would almost say 1950s stereotype of the husband controlling all of the assets and the wife being the homemaker. If the other spouse has not worked and they are in their 50s or 60s, you know, it's unlikely that they're going to be able to become fully supporting at that stage. So when you're considering a divorce, if your spouse hasn't been working for a number of years outside the home, you better consider the fact that you're going to still be supporting him or her. One of the factors that the family law code considers is the lifestyle of the marriage when they divide assets. Often the supporting spouse will argue that they need a greater level of support in order for them to continue in the life that they've grown accustomed to. Our role is often to assist both spouses in understanding the reality of the financial circumstances of the couple. That's why when I work as a certified divorce lending professional, and I'm brought into a collaborative divorce situation early on, we can figure out the best way to guarantee that both spouses are going to have a home to live in. One of those ways is to utilize reverse mortgages. And one of the great things about that is that once the couple divides, if one stays in the marital home, the other can get a reverse mortgage on their own, which guarantees that they can hold on to more of the cash assets and still own a piece of property that's going to appreciate without having to make payments for it. Couple of things I wanted to cover with you guys in my last few minutes today. The first is this. I really think that it's important for all of us to keep what I like to call a gratitude journal, all right? Just a way of keeping track of the things that are good that happen in your life, because we tend to, as human beings, focus on the negativity, and we tend to discount those good things that are going on in our lives. For example, don't just go through the motions. Research by psychologist Sonia, I can't even pronounce the name, Sombomersky, and others suggests that journaling is more effective if you first make the conscious decision to become happier. This goes back to something we talked about earlier, which is you control the way you feel. The way you think controls the way you feel. If you want to be happy, think happy and keep a journal of gratitude for the good things that are happening in your life. Go for depth over breadth. What that means is elaborating in detail in your journal about a particular thing for which you're grateful carries more benefits than just listing a bunch of good stuff that happened to you. Write about it, almost like you were leaving a diary for the future. Get personal in your journal. Focus on people for whom you're grateful and have more of an impact than focusing on things for which you are grateful. The people in your life ultimately are the things that are going to give you the most value over the course of your lifetime and keep you happier, and therefore you'll live longer. Try subtraction, not just addition. One effective way of stimulating gratitude is to reflect on what your life would be without certain blessings. And last but not least, I want to mention to you today that today is National Technology Day, National Cuddle Up Day, National Bean Day, and National Shortbread Day. So for those of you that have marriages that are in trouble, one of the things that I would suggest you do is consider cuddling up. Go buy some beans, go get some shortbread, go get the person that you fell in love with 10, 20, 30 years ago, get into bed with them, throw the covers over you, and cuddle up and watch a good film on that computer screen and, give National Technology and Cuddle Up Day and National Bean Day its due, along with Shortbread Day. I mean, can you imagine anything better than shortbread, beans, a computer in bed? I mean, what could be better than that, right?
In 20 years or so, dear, I wish that you were dead. I'll never love you then at all the way I do today. So please remember